This is Jim Simons, a mathematician who became the greatest trader in history. To be specific, from 1988 to 2018, his fund generated an average annual return of 66% before fees. That's 66% per year for 30 years straight. Warren Buffett averaged 20%. The S&P 500 averaged 10%. Jim Simons crushed them both by a factor of 3. And his net worth? Over 30 billion. His fund's total profits? Over 100 billion. But here's the crazy part. Most people have never even heard of him. Warren Buffett is a household name. Jim Simons is invisible. Why? Because while Buffett was reading annual reports and giving interviews, Jim Simons was writing algorithms. Now, if you're like me and you're thinking, how did he do that? Well, I decided to look for the answer to that specific question, scavenging the internet and research papers for the strategy he used to get those massive gains. And oh boy, did I find something really interesting. And I gotta say, Jim is an absolute genius. I'm gonna share it all with you guys. Let's get straight into it. Before we get into this strategy, you need to understand who Jim Simons actually was, because unlike every other legendary trader you've heard of, Jim Simons didn't start in finance. He wasn't studying charts at 3 a.m. He wasn't grinding in a trading pit. He wasn't even interested in money. He was a pure mathematician. And not just any mathematician, one of the greatest minds of his generation. In the 1960s, Jim worked for the Institute of Defense Analysis, cracking Soviet codes during the Cold War. The guy was breaking encrypted communications that determined the outcome of global conflicts. But his real passion? Pure mathematics. Abstract geometry that most people couldn't even comprehend. By 1968, he'd moved to MIT, then became chairman of the mathematics department at Stony Brook University. In 1976, he won the Geometry Prize for groundbreaking work in differential geometry. This wasn't some finance bro. This was a legitimate genius. Then, in 1978, something strange happened. Jim Simons, his pure mathematician who lived in the world of abstract theory, decided to start a hedge fund. But not because he loved trading, not because he wanted to get rich. He saw something that fascinated him. He looked at the financial markets and saw what everyone else was missing, statistical patterns hidden in what looked like random noise. Everyone else was using fundamental analysis, reading balance sheets, meetings with CEOs, trying to predict which company would succeed. Jim thought that was all pointless. He believed markets moved in mathematical patterns that repeated, not perfectly, but statistically. And if you could find those patterns, you could profit from them. But here's the key. These patterns were too small, too fast, and too numerous for any human to trade manually. You needed algorithms. So in 1982, Jim founded Renaissance Technologies. And from day one, he did something that shocked Wall Street. He didn't hire a single trader, not one. Instead, he hired mathematicians, physicists, computer scientists, and cryptographers. People who knew how to find patterns in chaos. People who could code. His employees included a former codebreaker from IBM, computational linguistics, and astrophysicists. These weren't people who studied the markets. These were people who understood statistics, probability, and algorithms. Wall Street thought he was insane. You're going to beat the market with a bunch of maths nerds who've never even traded? But Jim understood something they didn't. Trading isn't about gut feelings or experience. It's about finding statistical edges and executing them perfectly. And humans are terrible at both. We get emotional, we hesitate, we overtrade when we're winning and freeze when we're losing. Algorithms don't have these problems. The Medallion Fund, his flagship fund, became the most successful hedge fund in history. From 1988 to 2018, it never had a losing year, not one. Even during the 2000 dot-com crash, it was up. Even during the 2008 financial crisis, when the entire global financial system was collapsing, Medallion was up 98.2%, while Lehman Brothers were going bankrupt and traders were jumping out of windows. Jim's algorithms were printing money. By the time that he retired, Renaissance Technologies had generated over 100 billion in trading profits. So what exactly were these algorithms doing? This is where it gets fascinating. Jim's strategy was built on 3 core mathematical principles that most traders completely ignore. First, short-term mean reversion. Jim discovered that when price moves too far from the average, they tend to snap back, not because of fundamentals or news, but because of market structure and liquidity. Think about it like a rubber band. The further you stretch it, the harder it snaps back. His algorithms identified when stocks, currencies, or commodities had moved too far too fast, and they'd trade the reversion back to the mean. Second, momentum persistence. This is the opposite of mean reversion, but both patterns exist simultaneously in the markets. When prices break out of a range with genuine volume and conviction, they tend to continue in that direction for a predictable period. The algorithms could detect the difference between a fake breakout and a real one based on dozens of variables: volume, volatility, time of day, correlation, and other instruments. Third is volatility clustering. Volatile periods tend to follow volatile periods. Calm periods follow calm periods. If you understand this, you can adjust your position sizing and risk management accordingly. During high volatility, the algorithms reduce position sizes. During low volatility, they increased exposure. But here's the genius part that most people miss. These edges were tiny. We're not talking about 50% gains on a single trade. We're talking about 0.1% here and 0.2% there. Edges so small that by the time you paid commissions and slippage as a manual trader, they disappear. But when you execute these tiny edges thousands of times across thousands of instruments with zero transactional costs and perfect timing, they compound into massive returns. And here's the critical point. A human cannot trade this strategy. It's impossible. Some of Jim's positions lasted 15 minutes, others lasted 3 days, some lasted 2 weeks. The algorithms were trading futures, currencies, equities, and commodities simultaneously across global markets all the time. No human brain can process that much information and execute that many decisions with perfect discipline every day. Now, here's where I need to be brutally honest with you. Even if I gave you Jim Simon's exact strategy right now, you couldn't trade it. And it's not because you're not smart enough. It's not because the strategy is physically impossible for a human to execute. It's because the strategy is physically impossible for a human to execute. Let me show you why with a simple example. Let's say you wanted to trade just a mean reversion component. You'd need to monitor hundreds of instruments simultaneously, watching price deviations from their moving averages. The moment one of them hits your threshold, you need to execute immediately, not in 30 seconds, not in 5 seconds, immediately, because in high-frequency statistical trading, the edges disappear in seconds. But you can't just watch one market. You're trading stocks, futures, currencies, and commodities across different time zones. So while you're sleeping, opportunities are happening in the Asian markets. While you're eating lunch, European markets are moving. You need to be at your computer 24/7, never sleeping, never taking a break, with perfect focus and zero emotional bias. And even if you somehow manage that, there's another problem: position sizing. Jim's algorithms adjusted position sizes dynamically based on current volatility, correlation between positions, and dozens of other risk factors. They calculated this in real time for every single trade. Now, can you do the math in your head whilst simultaneously monitoring 500 instruments? Of course not. Here's what would actually happen if you traded this manually. You'd watch one instrument, you'd see deviation, you'd hesitate for 3 seconds wondering if it's real, you'd enter the trade. By the time you entered, the edge is completely gone. You got stopped out, you got frustrated, you'd start second-guessing the strategy. You'd miss the next 10 opportunities because you were managing the first trade. You'd end up with maybe 5 trades per day instead of 500, and your win rate would be significantly worse because of execution delays. This is why Jim Simons never taught his strategy to discretionary traders. He built algorithms to execute it, and those algorithms ran 24/7, never getting tired, never getting emotional, never hesitating, never missing an opportunity. This is why I started taking trading seriously. I made a decision early on. I wasn't going to be a discretionary trader competing against algorithms. That's a losing battle. Jim Simons proved 30 years ago that algorithms beat human traders when it comes to systematical edges, and today that gap has only widened. But here's the interesting part. You don't need a team of PhDs and billions of dollars to apply these principles. The technology that Jim Simons pioneered in the 80s is now accessible. You can build algorithmic systems that find statistical edges and execute them automatically. That's what I do. Now, am I claiming to replicate Renaissance technologies? Absolutely not. But the core principle is identical. You find a statistical edge that repeats, you build a system that identifies when that edge appears, you automate the execution so there's no hesitation, no emotion, and no missed opportunities, and you let it run while you're sleeping, while you're at work, while you're living your life. For example, one of my systems trades on a modified version of mean reversion. It monitors specific instruments for deviations from their statistical norms. When a deviation occurs that meets the specific criteria, the algorithm enters a position automatically. It manages the stop loss, it manages the target, it even exits based on predefined rules. The system runs the strategy that back-tested prove works. Could I trade this manually? Technically, yes, I could. Would I execute it as well as the algorithm? Absolutely not. I'd hesitate on entries. I'd move my stops too early. I'd take profits too soon. I'd miss opportunities because I was in a meeting. The algorithm doesn't have these problems. And this is why most retail traders don't understand. They're still trying to trade like it's 1985, manually analyzing charts, manually entering trades, manually managing positions. Meanwhile, algorithmic traders are executing thousands of trades with perfect discipline while they sleep. It's not a fair fight. Jim Simons proved that the future of profitable trading is algorithmic. Not because algorithms are magical, but because they remove the biggest weakness in trading, the human element. The emotions, the hesitation, the inconsistency. When you have a proven strategy and you automate the execution, you're trading the way the most successful fund in history traded. So let me summarize what we've learned about the greatest trader in history. Jim Simons generated a 66% annual return for 30 years straight by doing something radically different. He didn't try to predict the market. He didn't analyze company fundamentals. He found statistical patterns that repeated, and he built algorithms to trade them automatically. His strategies, mean reversion, momentum persistence, and volatility clustering, they all required one thing: algorithmic execution. Because the edges were too small, too fast, and too numerous for any human to trade manually. That's why, even though he's the most successful trader ever, most people have never even heard of him. He wasn't giving interviews or writing books. He was writing code. The lesson isn't that you need to be a mathematician or a codebreaker. The lesson is that systematic trading with algorithmic execution beats discretionary trading. That's what the numbers prove. That's what 30 years of perfect returns prove. So, if you're serious about trading, you need to ask yourself, why am I still here trading like it's 1985? Or am I ready to trade like the most successful trader in history traded? Thanks for watching. If this made you think differently about trading, let me know in the comments. And if you want to see how I apply these algorithmic principles in my own trading, check out the link in the description. I'll see you in the next one.